So an increase in it's about disposable income. Said a rise in disposable income will bring about increase in the rate of inflation. Here it's going to be demand pull inflation. We're still going to come back to demand pull inflation, but we're still on disposable income. So one of the factors that could bring about increase in disposable income is the increase in the real wage. Now I want you to deeply explain increase in real wage. Increase in real wages.
Okay.
Tell me.
So, what was the question?
What are the factors that bring about increase in disposable income? You said increase in real wage. Yes. Increase in real wage could be a reason why there's increase in disposable income. So explain how increase in real wage brings about increase in disposable income.
So, first, so when you have an increase in your how do I put this?
If real wage is being adjusted for inflation, that is called what?
Indexation.
Indexation. Okay, indexation is sorted. So now, what are those conditions that will bring about increase in the real wage? You know, as an employee, you can't just talk to employers that, oh, there's inflation in Libya, so you have to increase our pay. So what are those factors that will bring about an increase in the real wage? Real wage is a factor that could bring about increase in disposable income. So what are those conditions that would encourage indexation? Do you get my question now? Okay.
So, first thing you have that would increase your disposable income or your real wage is disinflation.
No, that's not what I want. We're talking about one factor, which is increase in real wage, right?
Yes.
So what are the conditions that will bring about employers? I don't want to break it down for you because I believe you are knowledgeable. You have that deep depth about economics already. So we are talking about real wage, which is an increase in real wage, which could bring about an increase in disposable income. We know that already.
Yeah.
Now my question is, what are those conditions that will bring about an increase in the real wage? What will make employers? I'm breaking it down, which I don't want to do, but let me do anyway. What will make employers accept indexation? Do you get my question now?
Yeah.
Okay. So what are those conditions that will bring about increase in the real wage?
Okay.
Should I help you with one first?
Yeah.
Increase in productivity. If productivity of workers are increasing, then firms, employers can be incentivized. Then they can as well listen to them and make adjustments to their wages.
Yeah. Also, what will make employers is also preventing quiet quitting.
Preventing high staff turnover.
So if inflation is at 5% and wages stay flat, employees effectively take a 5% pay cut, right?
Okay.
So this leads to low morale for workers.
Okay.
Therefore, this low morale would eventually lead to a lack of productivity by the workers, which would force employers, or rather made them obliged to increase wages, even though that's it.
I think I'm losing. I didn't really get the grip of what you said. Low productivity now or high productivity?
No, low. Well,
no, we've talked about productivity.
Yeah.
I talked about productivity. Increase in productivity could allow employers or firms to accept indexation, right? Okay, so what are you really talking about? Is it still productivity now or morale? You said
both. So because they're related. Because when you have low morale, you have lower productivity.
So if there's low productivity, you think with low productivity, firms would accept indexation?
No.
They won't.
Yeah, that's why I'm telling you they're following indexation. They're following indexation to avoid
To avoid
low productivity.
okay, to avoid okay. To we don't want. I've talked about productivity, so we don't have to talk about productivity
Okay.
again. So you're saying firms might be obliged to accept indexation,
Mm-hmm.
not to lose their staff.
Mm-hmm.
So to avoid, you can talk about to avoid high staff turnover. High staff turnover,
Yeah.
though it's business anyway, but high staff turnover means you're losing more of your workers.
Mm-hmm. Yeah. Also, like, I can mention another factor,
Okay,
which is competitive and regulatory pressure.
regulatory pressure.
Yeah. So
Okay,
sometimes the choice is taken out of the employer's hands by external forces. So first, there's industry standards. So if the large companies are adopting indexation, the smaller companies have to follow it because um, that would keep the employers basically in their company.
okay,
Uh,
okay.
Also, legal mandates.
Legal, it's mandatory for them to accept.
Yeah, because, for example, in some countries, the automatic wage indexation is a legal right or requirement. So,
But what's the difference between legal and regulations? I think they are
same thing, yeah.
Yeah, so we should put them in the same category.
Yeah,
Talk about something else.
yeah. Also,
Why are you not talking about increase in demand for goods?
I mean, there's inflation. How would there be a legal increase for goods?
I said we're talking about the situations that will bring about firms accepting indexation. So if indexation comes when employees, wants their wage rate to be in line with the rate of inflation, right? So why would firms? What are those reasons why firms would accept to increase the real wage? That's the point I'm talking about here. So don't you think the increase in aggregate demand can also increase in aggregate demand brings about inflation anyway. But what about the nature of this, the state of the economy?
Yeah, it would. Because
Tell me about the state of the economy. What does the state of the economy means?
if the economy is unstable, there's uncertainty for the firms. Therefore, they would have to increase the
The state of the economy in this context, we could talk about boom or recession. So if there's economic boom, firms might as well adjust their wage rate because there's incentive to do that. But if there's recession, we wouldn't be talking about increase in aggregate demand anyway. You get it? So okay, the real wage is done. So real wage could increase disposable income. Done. So here, okay, then you said okay now inflation rise may cause a negative real wage gap. So there's a deficiency in what your wage can be spent on. I don't get that. So now we're talking about the effects of increase in the wage rate, increase in inflation rate. So wage gap, inflation, wage gap. What about wage gap?
wage gap is it's the difference between what you used to be able to spend on and what you can't spend on nowadays.
Okay.
So like last year I could have spent I just needed to spend like 500 dinars, and this year due to inflation I'm spending about 800 dinars
For the same
for the same
basket of goods.
Yeah, for the same basket of goods.
Okay. So that's the gap there. So there's a division. Okay. So credit and the availability of loans will be more expensive, hence reducing consumer confidence as interest rate is high. Now tell me, he said the availability of loans will be more expensive. Effect. Now, in the case of the loan, with inflation, do you think borrowers are better off or savers? Who are better off with inflation? A rise in inflation. Who are better off? Is it the borrowers or the savers? Did you get my question or not? Okay. We have borrowers. You know borrowers? Those who have to
Borrow
which
money.
financial institutions lend money to. These are borrowers. Then savers are those customers that that deposited their cash or their money into the bank for a specific period of time. So with high rate of inflation, who is better off? Is it the borrower or the saver? And you have to give me an answer with explanation. Who is better off? Is it the borrower or the saver during inflation? Did you get my question now? So who is better off during inflation?
During inflation,
Yes.
who's better off?
Yes.
I would say savers.
Really?
Yeah.
Now before you explain further, now let me quickly chip in something. We said it is a general fact that during inflation, the price of money drops, the value of money drops. So if during inflation the value of money drops, which simply means what you used to buy, the value of the quantity of what you used to buy, you won't be able to buy the same quantity with the same amount of money. So to continue to buy the same quantity of goods, you have to spend more than what you used to spend. Okay, so if you have saved your money, do you think saving your money during inflation makes you better off?
No.
But you said savers now.
Yeah. Okay, I was wrong.
Savers, because you having your money with you, what your money could buy now won't be able to buy it in the nearest future, in the nearest period of time, based on the fact that the value of money has dropped. So if you have 500 now, which could buy this, with inflation, this can become 600. Then 500 that you've saved would not be enough to buy this. So now, borrowers are better off, right? So tell me, how are borrowers better off? I've given you the answer anyway. Now, justify borrowers being better off during inflation.
Borrowers are better off because credit is inflation dependent. So
Now, think deeply, please. Think deeply about it. Borrowers are better off during inflation. Why? So think about it. Think deeply. Think through the root of it. Borrowers are better off. Why are borrowers better off? It's inflation. Why are they better off? After all, prices are increasing.
yeah,
So why are they better off? Or maybe they are not even better off.
because prices are increasing.
Okay, so why are they better off? That's the point. Why are they better off? Do you accept that borrowers are better off during inflation? So why do you accept it? What makes you to think borrowers are better off during inflation?
Because borrowers are
For those who are just joining, the topic is about the rate of inflation and the effects of the rate of inflation. Now, when talking about inflation, it's simply about an increase in the general price level of goods and services within an economy over a period of time. That is inflation. So, we're simply talking about reasons, the effects of an increase in inflation. Here, he has mentioned a rise in disposable income. Yeah, because disposable income itself is the amount of money we can either spend or save. So if our disposable income is increasing, it simply means we have so much to spend or save. And in this case, we spend so much. And because the demand for goods and services are increasing, it will bring about an increase in demand pull inflation. And that is the case. So we have different effects here. The first one talked about is wage gap, which is understood. But now we're talking about the credit and the availability of loans. So credit and availability of loans take me to talking about the financial institution where we have the borrowers and the savers. The savers are those customers who deposited their money into the bank for a specific period of time. Borrowers are those who, who rely on the banks for credit facility. So the banks have to lend them money. So during inflation, the question now is, during inflation, yeah, we already understood that savers are worst off during inflation. And why are they worst off? They are worst off because during inflation, the value of money drops. And if the value of money if the value of money continues to drop during inflation, it simply means the amount of money available to buy certain specific basket of goods will not be enough to buy the same quantity of basket of goods. That is why savers are worst off. Now, my question to him is, why do you think borrowers are better off during inflation? And you've not convinced me yet. Why do you think borrowers are better off during inflation?
Because while inflation hurts the consumers, it may the debt stays fixed, right?
The
debt,
it's fixed.
Yeah.
Okay.
So while the debt number stays the same, the actual value of what they borrow decreases relative to the price of goods that change, if you get what I mean.
I got you, but those listening might not get what you are saying, so try to break it down.
So inflation erodes the purchasing power of money, right?
Yes, inflation. What he's saying is that inflation reduces your purchasing power as consumers. That means you won't be able to buy what you used to buy.
When you take out a loan, you are borrowing expensive, an expensive rate of money. So when you pay back years later during high inflation, you're using less money relative to inflation to pay back
what you've borrowed. So yeah, thank you. So for borrowers, let me just break it down here. For borrowers are better off during inflation because they have already borrowed the money. Or let's assume you borrowed 500 dinars to purchase an equipment. Then inflation came up. The equipment you borrowed 500 dinars to buy, you need to buy it because of inflation. It might be sold at around 700. So which simply means for the fact that you have borrowed 500 to buy the equipment, you're going to pay back 500 to the bank. And whoever has given you 500, if he or she needs that 500 would not be enough to buy the same equipment anymore because inflation has come up. So borrowers are better off because they are buying, because during inflation, the value of whatever they buy increases as they have the money with them. And those who has given them the money, the value drops. So which simply means they won't be able to have the same amount of money to buy what that amount of money could buy previously. Mm-hmm. And that is why borrowers are better off during inflation. So during inflation, for borrowers, they borrowed before the inflation rate. And as soon as the inflation comes up, whatever they borrowed that amount of money for would not be, the amount of the current price has exceeded the previous price, which simply means they are better off. It's a gain for them. And that's why borrowers are better off during inflation. So that is said. So now you said credit and the availability of loans will be more expensive, hence reducing consumer confidence as interest rate is higher. So these are other effects of increase in the rate of inflation. You said availability of credit becomes more expensive. Why do you think credit is more expensive? Why? During inflation. Why do you think during inflation credit is more expensive? And how can you even solve inflation rate? Demand pull inflation. How can you solve inflation? What policy can you use to solve high rate of inflation? What policy? Monetary policy. Okay. What kind of monetary policy can you use to solve increase in interest rates? Increase in inflation rates. There's inflation. Credit and availability of loans will be more expensive. You said it here that loans become expensive, credit becomes expensive. So to solve high inflation rate, we can use monetary policy. What kind of monetary policy can we use to solve interest rate? Uh, Inflation rates, sorry.
So, first of all, why is credit more expensive?
Yes.
Yeah. So by making it more expensive to borrow, the government hopes you will spend less. And you know when you're spending less, people spend less, demand for products drops,
Okay.
and